Namaste everyone. So hope everybody can see and hear from the
Yes.
online world.
Yeah.
Okay, thanks.
Yes.
Okay, great. So what we'll this is goes back to COVID times. When we were doing this, so I'm not 100% in terms of delivery. It may take me a few minutes to get used to this interface, hybrid interface. Yeah, but we'll try our best. All right. So first thing I need is the changer. Slide changer. Oh, he's going to get it. Okay. Room let Leah. Oh, it's good. Another class left. Just give me a few minutes and then we'll. Otherwise, I have to. The slide changer. He's going to get it. All right. So while we are waiting for the slide changer, in terms of how we'll cover the class today, the first thing I want to cover is the slides related to the ratio analysis chapter. Right. So wherever we left off, there were some things that we covered, but I went through it really fast because we were trying to do the project, and so I think it was not done well. So I'd like to just review that part again. We'll complete the slide presentation on ratios, which will feed into the project also, right? So in the sense that whatever we are covering here is related to the group project, and so in that sense it's relevant for that. But once we finish the presentation, we'll go through, depending on how much time we have, we'll go over questions from the class. So some of you have scheduled meetings with me in terms of for the project, but it's possible that I'll cover some of those topics or the questions in class itself, right? So at least for some groups, you may not find the need to meet me at the end of that. So that's what I'm. So let's start by going back to where. Okay. So very quickly, we were covering, looking at profitability ratios in this class. And if you remember, we had a return on equity, which is the ratio that shareholders of a company would like to focus on when they evaluate their company's performance. Right? Theoretically, it has been shown that ROE is the right ratio to look at when you are a shareholder, a common shareholder. Okay? So that is one ratio. There's a second ratio which is on the screen, which is return on investments, or in the textbook it's called return on total investment. Now, where will you use that ratio? Generally, you use it if you're considering performance from the point of view of the shareholders and the lenders or the liabilities. Now, that doesn't really happen. It's never the case that these two groups of people get together and say, let's try to value the performance, right? So that looks like a very theoretical construct in that sense, right? Return on investment. But one setting where people use it a lot is when you are evaluating a target for in M&A. Right? So you're trying to acquire another firm. That firm has its assets and liabilities and shareholders' equity. Right? So when we are looking at a firm, we are not looking at its equity alone, we are looking at its total, all of its assets, right? Because we're trying to acquire it. So in that sense, ROA makes sense in the context of mergers and acquisitions. So it's used more relevant for performance evaluation when you're considering acquiring another company. Okay. So these are broad settings or broad, when would you use ROE and when would you use ROA is what we covered. Now there's a third ratio which I'll get to in a second, and that's the part I didn't I covered very quickly. So give me a second. So all this is done. improving on ROE. Okay. So what happened here is we got into the project and you started computing net operating assets, right? And then we had this discussion, and then I backtrack and said, okay, why are we doing this, right? So let's put the horse before the car, right? So why are we doing this? I explained it a little bit, but I'll do it a little bit more slowly and formally in this class. So this third ratio for profitability evaluation is return on net operating assets. So what it does is it improves on ROA. Now ROA has two main defects. One is, like we discussed, is the denominator for ROA is total assets, and the numerator for ROA is net profit. Let's forget about preferred dividends. So the problem is the denominator in ROA has liabilities and shareholders' equity, but the numerator has only profit. So the return to the people who give loans or liabilities is missing in the numerator for ROA. So RNOA fixes that. So what it does is it adds an interest expense, which is the return to the liabilities, on the numerator side. Okay? So that is one thing that is different between ROA and RNOA. We have an interest expense addition in the numerator. I'll do this on the board also, just for clarity. And then theoretically we said, okay, when we add back interest to the numerator, profit becomes larger, and therefore we have to pay additional taxes. Therefore, this is a hypothetical calculation. If we add back interest, the profit would become higher. Therefore, we would end up paying more taxes, and the tax rate, let's say, is 30%. So we take 1 minus 30% or 70% of the interest and subtract it. Right? So that's what. We take 30% of the interest and subtract it, which works out to, on a net basis, 70% of interest. Okay? So that's the first thing. So what are we doing again, just to review? RNOA improves on ROA as a performance measure because it makes the numerator and the denominator consistent. The denominator has the investment made by the liabilities and by the shareholders. Numerator similarly has the return to them, which is the profit for the shareholders and the interest for the lenders or the liabilities. Okay. Now there's one more thing, which is the second reason why RNOA is better. I'll have to explain this on the whiteboard. It's there on the next slide. Okay, so this formula may not be so clear. Is you able to see it from the back or full screen? Yeah. Okay, so this is a kind of a subtle point, but I think worth talking about, which we never discussed, which gets to the second aspect of RNOA. One is RNOA is a return to, the proper return to all the people who provide money. ROA is not really that. Second is, it's also can be viewed as purely operating performance. Okay? It can be viewed purely as an operating performance measure. Now to see that, I'll do this on the board. That is straps. Can you hear me in the back? Yeah. Okay. All right. So we are going to go over the formula again for RNOA and why it is the way it is and its interpretation. So the denominator, we'll start with return on assets. It has net profit. And there's a line here already, but I'll still draw that line. And we have average assets. So this is your formula for ROA. And this is equal to, again, net profit. I'll use the acronym NP for that, divided by average liabilities plus average shareholders' equity, right? We know that just mechanically from the balance sheet equation, right? So first thing that we do, I'm just repeating this because I said that this in words. Now I'm trying to repeat it using the board, right? It's all very repetitive, but it's still good. So what you see is the inconsistency. You see net profit is the return to the shareholders, but liabilities, these guys are left stranded. They don't have any return there. So we have to help them out and put a return so that we get a measure of performance, which is the return to all providers of capital. Okay. So how do we fix that? Like I just said, we are going to take this and add interest expense. So what is confusing about this is profit is a nice, good thing for shareholders, whereas interest is a bad thing for shareholders, right? But so it looks a little confusing because we are taking two opposites and putting them in the numerator. But the way to see it is each of them is a return to the people who gave money to the firm. So it's not really opposite of each other. They are both returns to the shareholders and lenders. So that's the second thing we do. We add interest and now it's consistent. Then there is what we call an unintended consequence of adding interest is that we have to consider taxes. So what we do is we subtract the tax rate minus the tax rate times the interest. Right? So this is, let's say the tax rate is 30%. So it's 1 minus 30% of the interest. So that's why it works out to 70% of the interest. Right? So now this is a better formula because we have consistency. But the second defect of ROA, which RNOA takes care, is the denominator is still not pure or not good, in the sense that the denominator has some liabilities which don't bear any interest, right? So we want to have only, because you have interest in the numerator, that is the return to the lenders, but things like wages payable, trade payable, and rent payable, all of those liabilities don't really give any return. So what we have to make it really consistent, we have to clean up the liabilities number in the denominator and have only interest-bearing liabilities. Okay? So I also refer to this, not in this, you don't have this here, but sometimes I call these financial liabilities. Okay? So we have financial liabilities and everything else we call operating liabilities. Right? So you take total liabilities and divide it up into financial liabilities and operating liabilities. So what do we need in a denominator to make it all really consistent is financial liabilities, right? So that's what we're going to do. So the final version of the formula, which is really clean, is going to have net profit plus interest expense. This simplifies into 1 minus the tax rate. So we call the numerator net operating profit, right? We'll come back to that word in a few minutes. Denominator, what are we going to do? Rather than having average liabilities, we are going to put financial liabilities or interest-bearing liabilities, right? So I'll write it out as interest-bearing, interest-bearing liabilities plus the same holds average shareholders' equity. Okay? Now everybody understood the logic behind the formula for return on net operating assets. What are we doing here? It's mainly about consistency between numerator and denominator. It is a return. Return means how much did you make on your investment. These two people, the people who lent us money and the shareholders gave some money, for them what is their return? Interest and profit. Profit is not really a return. The actual return is the dividend and the capital gain. But a profit is an indicator of that. Okay, so in the sense, more profitable you are, more will be your capital gain in terms of the stock price going up, etc., etc. So there's a little bit of a poetic license I'm using. Okay, so that covers. Now we have one more thing. So the formula says return on net operating assets. So some of you may have this question, okay, why is it return on net operating assets? The denominator has interest-bearing liabilities and shareholders' equity, which has nothing to do with assets, right? And even for the project, when we did this in class or when you worked on it, I've asked you to calculate net operating assets. I said take all the interest-bearing liabilities, which is borrowings, lease liabilities, short-term and long-term, and add the shareholders' equity. So generally you'll have 5 numbers, that you add and then average of that, right? So the question that we have to address is, why are we using the word net operating assets? And the reason that comes out is that's shown on the slide, but I'll do this on the board, is that this same thing which looks like liabilities plus equity is also, because of algebraic equivalence, it's also a form of assets, right? So to see that, we just have to look at the formula and write this out here. So you have, I'll write it here, assets is equal to liabilities plus shareholders' equity. Okay, so I hope you guys can see from the back here. Right? And I don't know what the people online, can you all see it? I'm writing?
Yes, Professor, can see.
Okay, fine. So now we break this up into assets is equal to operating liabilities, I call it OL, plus I can say interest bearing or financial. I prefer to use financial, but it's the same thing. So financial liabilities plus shareholders' equity. Okay? Very simple algebra. Now all you have to do is take the operating liabilities to the left hand side. So what will you get? This will imply that A minus OL is equal to financial liabilities plus shareholders' equity. Okay? Which is what you have in the formula. So financial liabilities plus shareholders' equity is nothing but total assets minus operating liabilities. It's another, they are equivalent, right? And what is that? If you just intuitively assets minus operating liabilities, we call it as net operating assets. So that's where the word return on net operating assets comes. Okay, so now we know what this RNOA is. Now two more things to do. Right? So as far as RNOA is concerned, how do we use it? What is the interpretation? Right? There are two ways to interpret RNOA. One is to think of it, they are both related, but is to think of it as a measure of performance that is not affected by capital structure, policy, or choice. In other words, capital structure policy means how much do you borrow? What is the rate of interest that you borrow? When you borrow a loan, you decide how much you're going to borrow and how much interest you're going to pay the lender. Right? So that is the job of the finance department, the CFO, and the treasurer. That's they're paid X million rupees to save, make the right amount of capital, borrow the right amount of capital, and pay the lowest interest possible. They try to minimize borrowing costs. Okay? So this measure, so back to our RNOA, this measure is invariant to capital structure policy. So what does that mean? It means that no matter how much I borrow, there is a caveat to this, but I'll just make a claim and then add the caveat. Right? No matter how much I borrow and how much interest I pay on my loan, this measure is not going to be affected. Okay? Now, can I prove this? I'll just use what we call in economics hand-waving argument. Right? So just intuitively, if you look at the numerator for RNOA, it's net profit plus interest. So net profit, you've subtracted interest. Now you're adding back the interest, minus plus, cancel out. So the numerator will not be affected by your interest. So no matter if one firm may pay a lot of interest, we're going to add it back, so it won't be affected. Another firm may pay no interest, that will also not be affected by interest. Or it pays a small amount of interest. So no matter what your interest you pay, this net operating profit is not affected by interest expense. Right? So that way you can do an apples to apples comparison of two firms. Let's say two firms, same industry, and you want to find out, okay, I want to look at their performance, but I don't want it to be affected by how much they borrowed and the interest they are paying. Because that's something else. That's a finance department thing. I want to just look at their operations. How do they run their business? Right? I don't care about what the finance department did and how they managed to minimize the cost of debt or the cost of loan. Right? So then this net operating profit is the right measure to look at. Okay? So it's again invariant to your interest rate and the amount of interest you're paying. Similarly, the denominator, the explanation is different. You think of it like this. There is borrowings plus equity. Very different type of explanation, not like the first one. Let's say you have two firms. One firm has $100 of assets. It's borrowed 60 and it has equity of 40. Another firm has the same $100, so we are making apples to apples. Same $100 of assets, but it has borrowed 70 and has equity of 30. Right? So these two firms are different in terms of their what we call the debt to equity ratio. Right? Even though they're different in terms of the debt to equity ratio, the total 100 is the same. Right? So that is what the denominator is trying to capture. So the proportion of debt to equity could vary across firms, but the total is going to be unaffected. So in that sense, in a very, very specialized sense, the denominator is not also affected by the ratio of debt to equity. Now what is the caveat? It will be affected by borrowing. In a sense, if you borrow more, the denominator will go up, right? So the definition of invariance to capital structure has to do with, in the denominator, is related to the proportion of debt to equity, not the amount borrowed. Whereas the numerator is unaffected by amount borrowed and interest rate, right? So it's not perfect, right? But at least it's getting there. Right? So overall, the point of this ratio, one point, is to come up with a measure of performance that is not affected, is not tainted or contaminated by a capital structure policy. So you can think of a business as there are people who are doing the marketing, the production, and etc., right? R&D, that's operations. And then there's the finance department, whose one job is to reduce your borrowing costs. That's an important thing, okay? And decide how much to borrow. So we are trying to divide the business performance into two measures of performance. Okay? And RNOA is capturing performance which is not affected by capital structure. Now the second interpretation, which is also intuitive, it goes back to this definition A minus OL. So you're looking at rather than thinking of it as providers of capital and their return to them, think of it as how much I'm putting into my operations as assets. Right? So this is my return on my operating assets or net operating assets. Right? So it's a measure of operating performance. It's just different ways of saying the same thing. So when I want to look at pure operating performance, I'm going to look at RNOA. Now go back, so let me just pause here and see if people have questions, and then I'll say one more thing. Questions? Okay, so let me just complete and then maybe if you have questions. So the second, go back to ROE. Now the final point of this whole discussion, go back to ROE. Return on equity is intimately related to financial policy. In fact, remember that the three component model, ROE is equal to margin, which is like operations, times turnover, times leverage. So the lesson there is, the more you borrow, generally, the more you borrow, the asset to equity ratio goes up. That means you're borrowing more. That will cause your ROE to improve. And therefore, ROE is affected by financial policy, your capital structure policy, how much you borrow, how much interest you pay, whereas RNOA is not affected by it. Okay, so what does that mean? And then there is a formula which I'm not going to show here, that's called the advanced DuPont model. But that formula basically says your ROE has two parts to it. One is RNOA, and the second is the financial return. So you can divide up ROE into RNOA and financial return. So let me just write that out on the board. So ROE is equal to RNOA plus, I'm just going to call it a financial return. Okay, so what does this mean? It's the effect of leverage. It's the additive effect of leverage. Okay, so what is really nice about this, I'll just elaborate a little bit here. When we did the DuPont model, it's a multiplicative model. Okay, so ROE is equal to margin times turnover times leverage. Here we are doing a different way of splitting ROE. We are saying ROE is RNOA, which is a totally different animal, plus something which I'm calling the financial return. Okay? Now, without getting into the details, this financial return will be affected by how much you borrow, and it will be affected by your interest costs. Right? Those details I'm not giving, but I'll share a separate slide later so that for those of you who are interested, you can look at that formula in detail. Now, which brings us to the project, right? So the last thing I want to say is, when you do the project, one of the questions I've asked you is discuss the trends in calculate the RNOA and discuss the trends in RNOA and tell me what do you think. So there the issue is, I want you to relate it back to this idea. So you're going to say ROE is trending in a certain way, it's going up or going down. RNOA is trending in a different way. And that difference, if you find the difference between ROE and RNOA, that is giving you the financial return. And that is telling you why that difference is going to tell you whether the shareholders are earning a return better than operations, more than or less than operations. Right? So your operations are giving you a certain performance. Let's say 10%, 11%, 12%. ROE, let's say, is 16%, 17%, 18%. Right? So that means the CFO guy, the people in the finance department are doing a great job. They're giving you this extra return of 5%, 6%, etc. So that's what I want you to talk about. Now, for some groups, it'll go the other way around. It'll be possible that ROE is less than RNOE, especially COVID times, recession, etc. Then you may have borrowed a lot of money, and this leverage will come back and hurt you. So shareholders will actually earn lower than the normal operating returns because your finance department did you what is the opposite of favored? Disfavor or whatever, right? So they borrowed so much that suddenly when the bad time came, like COVID or recession came, they borrowed a huge amount, but their operations tanked. And so the leverage ended up hurting. That's why we call it leverage, right? It can magnify your performance. Okay? So that last part is a little unclear in my mind itself because the way I explained it to you, I mean, I know what it is, but I don't know if you guys got the idea. So let me know. So that's all I wanted to say, but let's see if there are questions about this interpretation. And then we'll go to the liquidity and multiples. That's how I want to in the class. Any questions from the other side of the world? Or the, yeah? Now, RNOA and ROA, you can't really, the comparison is all about, yeah, okay. So ROE, think of it like this. ROE is what the shareholders earn on their investment. Okay? I am a shareholder, or all the shareholders collectively have put like 10 crores and they get 1 crore as a profit. That means their ROE is 10%. Now we are saying that this 10% we can actually divvy it up into two parts. One is the part related to pure operations. How did I run my business, my production, my marketing, my R&D, etc. The second part is how did I manage my capital structure? How did I manage how much I borrowed and how much interest I paid on my borrowing? They are two different functions. The formula is saying these two can be divided up orthogonally. They can be made orthogonal. Orthogonal means they are independent of each other. And that is why I went into this whole spiel of saying RNOA is not affected by capital structure. They are orthogonal to each other. They are independent, right? So the differences are, so if your ROE is 15%, and then you calculate RNOA independently, and you get a 12% RNOA, that means the finance department allowed the shareholders to generate an extra return of 3% because they were clever about how much they borrowed and the interest they paid. Right? So that financial return, this 3%, is telling you how well the finance department did their job. That's important, right? So they have a role to play, right? And that's their role. They have to minimize their cost they have to borrow money at the lowest rate possible and borrow optimally. Not borrow too much or too little. And that 3% is giving you how did the finance department perform. That's the difference. Okay, so any other questions? Right. All right. So we move on to the next topic, which is liquidity. Okay, so before we do liquidity, there's one slide which gives a summary of all the ratios we covered. So this is summary of all the profitability ratios in one page. Okay, so that's just something for your reference. You can look at it. So there's one ratio which we didn't cover, which is earnings per share. And in the project, I'm asking you to compute it, but it's a very simple thing. You can just go and look at it, find it in the annual report. It's just like any other measure of performance. So with return on assets, you're taking profit by assets. So here what you're doing is you're taking profit divided by shares outstanding. The reason we include it in generally is because that's the number that analysts are forecasting. And so it becomes something important to track and see how the firm is performing on it. It's very similar to ROE, RNOA, ROA, etc. Nothing varies, right? right? If you run a correlation, they'll be 0.8, 0.9, etc. But it's the most popular measure of performance, right? If I can say one thing, the advantage of earnings per share as a metric, there are advantages and disadvantages, right? The advantage of it is shares outstanding, the denominator tends to be very stable. The likelihood of a firm issuing equity, new equity, based on empirical data is about 5% in a year, the unconditional probability, right? If I go and ask any firm, just pick a firm and say, what's the likelihood this firm is going to go and issue more shares, new shares? It's very, very low. Most firms don't, they go back to the market and raise capital with a very low probability. So that's about 4% or 5%. Right? So the shares outstanding will increase whenever you issue new equity. Right? So that shares outstanding tends to be very stable, but it's also an indicator of a measure of size. So when we divide earnings or profit by shares outstanding, you're removing the effect of size and you're getting a stable measure of profitability. Right? So shares outstanding, okay, very good question. Right? Shares outstanding is, think of the following. You are just started your company, you're registered yourself as a company. What you do is you will issue shares to your different shareholders. Let's say it's just you and a partner, and you form a 2% company. Right? So you will put 100,000 each, so you have capital of 2 lakhs, and then you have to decide what is the price per share. Right? So if you divide it, let's say it's 2 rupees per share, you'll get 1 lakh shares. So you will get 50,000 shares, and the partner will get 50,000 shares. So the 100,000 is your shares outstanding. How many shares have you issued so far? That's what it is. Right? Each time you issue equity, new shares, that denominator, that number will go up. When you buy back shares, it will come down. Okay, so the defect with earnings per share, the problem is when you do a buyback, suddenly in that year alone, the shares outstanding will drop. Earnings will not change much, right? Because it's buyback is just you're returning cash to the shareholders. They are surrendering their shares and you're giving them cash, right? It's just like a withdrawal. Think of it as like a withdrawal. So suddenly, dramatically, shares outstanding will drop. Earnings will not change much. So in that year, earnings per share will just skyrocket, right? So there's a claim, and it's been empirically proved in research that yeah. Uh-huh. Trade payable? Okay. Yeah. Oh, there was some example, okay. Okay. Uh-huh. Yeah. So in terms of our equation, you had trade payable of 1,000. This is an example from Pradeep, sorry. So Pradeep had a question. So there's 1,000 rupees of payable. So you're trying to settle. You can settle fully in cash. Rather than giving them cash, you gave them some shares, right? So the supplier is getting shares. So 500 rupees, you reduce payable by 1,000, you reduce cash by 500, and you increase equity by 500, right? So that's how the equation is getting balanced. So that now what is happening is supplier is becoming a shareholder. That's all. Anybody can be a shareholder. It's going up. Yeah, you issue more shares. For example, in an IPO, the lawyer, the underwriter, they will all get shares. Instead of giving them, because cash is so, for a startup, you don't have much cash. So what you do is to make them happy, you give them shares. Right? So that's how the lawyer gets paid usually. Okay. And you get a little bit of cash and you get stock. Hopefully the price will go up. Right? I'm sorry? Yeah. Okay, what is the motivation for the company? Yeah. No, that's basically the motivation is you have these, what do you call them in India? ESOPs, right? Right. So you have these plans, they make a plan and they say that normally it's performance linked. If your performance of the company reaches a certain place, then or your personal performance is up to a certain level, then they'll give you issue shares. So that's more like a motivating device, right? So if you idea is you work hard and the share price goes up and you get something valuable, right? I'm sorry? Retention, yeah, motivating you to work harder and also to retain you, right? Yeah. Yeah. So what will happen, it depends. In India and in US it's different. One of the main reasons you buy back shares, we're kind of going off topic, but I'll just go ahead and answer the question. You're buying back, let's say, 10,000, 100,000 shares, right? What happens is the company will have a lot of stock options outstanding. Okay? What is a stock option? It's you're an employee, let's say, and as an employee you have 1,000 options, right? Which is a piece of paper saying you have the right to buy shares at a future date. So so that date is called the vesting date. After the vesting date, you have the right, right? So normally, let's say I give you options, 1,000 options. I'll say you'll have to stay on in the company for 2 years. And after 2 years, your vesting period is over and you have the right to exercise the shares. So what will you do? After 2 years, you work hard, that's the idea. Share price has gone up. And then you say, I'm going to exercise. When you exercise, you will exercise. What does exercise means? It means that I'm going to give you, the company, some money, and you will give me the shares instead, right? The options will get converted to shares, right? So the money you give will be equal to the exercise price, which hopefully is very, very low compared to the current stock price, right? So that's how you'll make and then you'll turn around and sell those shares and make a little profit. Okay? Now, to giving you the shares, you've exercised the options, and I have to give you shares. Where will I get the shares from? I don't want to sit and mint out new share certificates. So I would have bought back. So one of the motivations for buybacks, you bought back all these shares and you keep them in your kitty. And then you return them in the form of, reissue them in the form of options. Exercise, shares issue. That's the idea. Okay. So the buyback, basically we call it treasury stock. So those bought back shares, they're still sitting there. Right? They just been removed from circulation. Right? And so we can reissue them and give them back. Because it's very expensive to do what the law says. Whenever you issue new shares, you have to go through this whole drama of filing a registration statement called an S1, and you have to get an underwriter and you have to pay a fee to them. With stock options, when you reissue, you don't need to do that. You just have to file something called an S8, right, and you're done. So it's very cheap that way. Right? So that's the motivation for it. Okay, so that is the end of profitability. Now we'll move on. Yeah. Yeah. RNOA, what is that? Yeah, the same thing, it's the same thing. So I have net operating profit divided by average net operating. Yeah. This formula is a simplified version. So when you actually do it in practice, it's a little bit more complicated because you have to. Okay, so now we'll move to the second topic. So what we'll do is go the liquidity and solvency ratios, which we didn't cover in class. So my main focus here is to give you the formulae and discuss the interpretation of liquidity and how do you interpret liquidity and solvency ratios. In general, it's way more simple than, I think, they're way more simple than the profitability ratios, right? More intuitive and easy, so it won't take too much time. But still, I think it's important to cover it. And then we link back to the project when you have to calculate these, where you get the data. Okay, so broadly, liquidity and solvency are mainly related to lenders. Right? These ratios are more important for lenders. Shareholders don't really care about them. So the shareholder all the shareholder wants is dividends and capital gains. And the linkage between your cash balance and dividends and capital gains is not great. Of course, you need cash to pay the dividends, but generally, the linkage is very weak. Right? The people who care about liquidity and solvency are the lenders. Right? So it's a different shift. The perspective is very different now. Right? So we are talking about lenders and creditors, etc. Okay? So the main thing lenders want is they want their money back, the money lent, and they want the interest payment on time. Right? So these ratios are intended to help the lenders evaluate if this company is going to default or not on the loan. Right? So there are two things that you want to think about, and this is very relevant to the Indian context, and some of you may be familiar with this. We have this default crisis, right? So it's now not so much in the news, but when Dr. Raghuram Rajan was the governor, there was a lot of discussion. And I don't know if you read this news story. There was a story in 2017, I think, or 16 or 17, where unexpectedly the Bank Officers Association. So the banks have officers. All of them have, together collectively, they have an officers association. And they said, we are going to publicly in the newspaper announce the names of all the defaulters of our banks. So there was a public, Professor Rajan was telling them, don't do that, right? But they didn't listen to him, and so everybody, there was a shaming of everybody in public, and this came out. And so you can all look at it. So that became public information. Now, I'm digressing a little bit, but if you have access to the CIBIL website, CIBIL is a credit rating agency, right? So what do? They give you credit ratings, right? So if you go to their website, you can actually get, if you know a little bit of Python, you can get the list of all the defaulters, right? Now back to the slide here, there are two types of defaulters in India, right? And this categorization is done by the lending banks. And it's a controversial thing. So one is what we call willful default. The other is called non-willful default. In the CIBIL website, they are referred to, the non-willful defaulters are referred to as suit-filed cases. Right? That's the word they use. Right? So you have willful and non-willful. So what does non-willful mean? Non-willful default means it's not your fault. You ran the business to the best of your capacity. Things didn't work out the way it should have. Customers didn't buy your product, etc. Your expenses ballooned, and so you ran into a loss, and now you're saying, I can't pay the loan. Okay? So the bank usually will send a notice to once there's one default and one interest payment is missing, meaning that is not paid, immediately the bank will send them a notice saying, please pay the interest, and then they don't pay it, then the lender, borrower becomes in default, right? So the borrowers which are in default because their business was not run well are called non-willful default. Willful default are the cases where the bank thinks these guys have the money, they are not paying the money because they just want to defraud us. Right? The classic example, is a Bangalore citizen who is now in UK. Right? So the companies, of course, are very upset about it because they're saying genuinely we can't pay. Whereas the banks are saying you have the money, you have put it somewhere and you're not paying. And so these are called the so-called willful defaulters. Okay? So why did I go through this? The thing is, it's a very interesting question. How do we find out who is a willful and who is non-willful, right? So that's an interesting question. But the ratios can't really tell you anything about that, right? So that's why I put this up front. So the ratios can tell you about the ability to pay, but it can't tell you about the willingness to pay. Willingness to pay is a psychological phenomenon. It's a behavioral thing. I may have the money, my current ratio may be very good, but I'm still not willing to pay, and that's because I want to cheat you. Right? So that's the ratios can't. Right? So ratios can tell you ability to pay, but not willingness to pay. So something you want to keep in mind. Okay. Okay.
Sir, just one question. Who exactly is deciding that either the company or the person is willful or?
Yeah, that is the banks. Each bank the banks send to the RBI a list of willful defaulters. So now how do they make this decision? It's like a black box. So they come up with some calculation and they say that these are the list of willful defaulters, the others are normal defaulters. And that CIBIL website gives you these two categories, right? Willful and not. Right? So some of our PhD students are researching, trying to separate what are the differences between these two groups. So the banks make this decision, and so some of the press, if you look at the companies are like, why are you putting us in a willful category? They're kind of upset about it. Okay, so this is a broad overview to tell you when you are a lender, what are you thinking about? You're thinking about how much cash is being received by the company. So the left-hand side has the sources of cash, right? So you have cash from operations, that is your cash profit. You have cash from selling assets, so these are all inflows, and then cash that you borrow from the markets, either equity market or obtain from the equity market or borrow from the loan market. So this is your pool of funds, and from that pool of funds, what do? There are three ways in which you spend that money. One is you use it to fund your operations. You pay your salaries, pay your regular operating expenses, etc. So that's the first bucket. And the second, if there's anything left over, this is what finance theory says. First thing you do is you take care of your operations. If there's anything left over, then you go for growth. So you buy a plant, equipment, etc. So that's the second form of a second application of funds. And then if there's still something left over, you have a lot of money left over, you've gotten a cash profit, you have invested in a little bit for the future, there's a lot of anything left over, we call that free cash flow. Right? So this measure of free cash flow is followed a lot by investors. So if you have a lot of free cash flow, then it can be good or bad. Right? So if you have a lot of free cash flow, maybe you're not doing a good job with the money, just keeping it. Right? Or if you have some others may say you've generated a lot of free cash flow, so that's good. Okay? So if you have a lot of free cash flow, you can you can either repay your borrowings, or you can buy back your shares, or pay extra dividends. You want to reward your shareholders and pay them dividends. Right? So this is just like a storyline for how money comes in and goes out of the company. From a lender's point of view, the point of this picture or this graph is to say that lenders, when they look at this picture, they're going to say there is a problem here because you are giving money, and that money can be taken and applied in any way the management wants. Right? So we call this an agency problem. Have you encountered this word before? Agency problem. So very simple. So I'm a lender and I give you money, but I can't monitor you because I'm not there every day in the office. Right? So I give the money and then you disappear with the money. Right? So because I can't daily monitor how you use the money, you can take that money, for example, and pay it as dividends to the shareholders. Imagine I'm the lender and I give it to you and you pay it to yourself. Would you be happy as a lender? Probably not, right? Why did I lend you money? Because I want you to invest in projects which generate a good return, right? So that's why the lenders will put a clause. So if you look at the loan agreement, we have things called covenants, right? So the reason I'm going through this is to give you some institutional knowledge, right? So we have these so-called loan covenants. They're very, very important if you're a lender. And the covenants will say, one of the covenants will say, you cannot pay dividends more than a certain amount. That's to protect the lenders. Similarly, the lenders are very conservative. They don't want you to invest in very risky projects. And mergers and acquisitions are very, very risky. Okay? So lenders will say you cannot invest more than X dollars in M&A. Right? So these are the ways in which, because the right-hand side is not in your control, and you can't control how the management uses your money. So you put these covenants as a way to protect yourself. Right? So that's why I showed this picture. Okay? So the other way you protect yourself, so one is to say don't do these activities. So these are called negative covenants, right? So negative covenants restrict the payment of dividends, engaging in M&A or other risky projects. But the positive covenants are covenants which are linked to the ratios, which is my segue to the ratios, which is the last part of this segment, right? So what do? We look at, so lenders in their covenants, they will say you have to maintain a current ratio of 2:1. You need to have ROE at least 15%. You need to have a liability to equity ratio of not more than 3:1. Right? So these are all intended to protect the lenders. Right? So if your profitability is coming down, the lenders are not going to be happy because they won't get their interest. Current ratio is very low, they won't get their money back, and so so all these covenants are in place. And so if you violate a covenant, it's really, really costly. Right? So if you, as a firm, you borrowed money, your current ratio drops below 2. Let's say the covenant says 2:1 is here, and it becomes 1.99. Immediately, the lender is going to catch you and say, hey, listen, we got to renegotiate. And they will say, okay, you fell below the limit, and so you're paying 6%, I'm going to make you pay 6.5 now. Right? So covenant violations are very, very expensive in general, unless you have some kind of a relationship with the lender, right? Which CEO may know the CEO of the bank, and that may help them avoid this kind of a treat. Right? So those are all interesting things that happen. Right? So I won't get into those details. It's just a lot of funny stuff that happens with these covenant violations. right? But generally, the ratios are relevant because they trigger covenant violations if those ratios fall below a certain, right? So that's the kind of the setup for why I'm looking at these ratios. Okay? So let me pause and see if there are questions from. I'm going off the. Yeah, any questions from that side or any one here before we cover the ratios?
In the quick ratio, in removing the inventory piece, so what does this exactly represent?
Okay, I'll come to that in a second. So let me go over these ratios one by one. First one is current ratio. What does it signal? It's telling you how much coverage do the current liabilities have. Current liabilities would be, what would be examples of current liabilities? You all know this, but for completeness, just give me one or two examples. Sorry, lease liabilities, the current version of lease liabilities, trade payable, etc. Employee wages payable, other payables, etc. Okay. So these are the people generally operating liabilities, but some financial liabilities are also in here. And so you're finding out if there are enough current assets to pay off the current liabilities. Remember, this is 1 year definition. These are the assets which are likely to become cash within 1 year. Current liabilities are the ones which are going to pay within 1 year. So this ratio, the old textbooks say this ratio should be 2:1, but that's like a very old idea. So there is no optimal ratio which is like a fix for all companies, right? So for some companies even 1:1 may be okay, right? So there's no benchmark. The only thing you want to track when your project, now we'll link this to the project, if your current ratio is trending downward, then that might be a problem that this company has in terms of liquidity. So that's something you want to look at in terms of your trend. Now to the question on quick ratio, this is a variation. Current assets includes a lot of assets which are not really liquid, right? Classically, we say inventory is stuff that is sitting on the shelf. For it to become cash, we have to first find a customer. So it's more, and therefore it's going to take a while. So suppose you take 30 days to sell your inventory, right? Or 40 days to sell your inventory. So you have to wait for 40 days. Then the customer has to take another 30 days before he will pay or she will pay. So you're talking about something which will take 70 days before this inventory becomes cash, right? So the reason we subtract inventories is because we want to keep only liquid assets in the numerator. Okay, so the current liabilities remain the same. So the people who have given us some kind of a credit, they are still looking, but they are more interested in very, very liquid assets. Right? So a variation on this is not the best formula in my opinion. What you want is, you want to put in the numerator of this liquid quick ratio, you want to keep cash, short-term assets, short-term investments and receivables. Those are the three which are very, very liquid. Receivables also sometimes they're not very liquid, right? So you want to get a better indication of how liquid the firm is. You take cash balance, short-term investments, which you can find on the balance sheet, and third you add receivables, and that will be better, right? The reason is some of these current assets are, I mentioned this to one of the groups, is not really liquid. It can't be converted to cash, right? For example, is prepaid expense. You all remember the prepaid expense from our class discussion, right? You pay something in advance to the insurance company, prepaid insurance, and then that becomes insurance expense later on. But this prepaid insurance, once you paid it, you can't really sell it anywhere and make it cash, right? All you can get is some coverage, which is not really cash, right? So to that extent, prepaid insurance is not a liquid asset, right? So that's why this current assets minus inventories does not really do it, in the sense that it has some illiquid assets in there. Yeah. Receivables also, we can put a question mark. Sometimes it depends upon, we'll look at days receivable. If your customers are paying very, very quickly, then that's fine, right? So then you can look at it. But if you have very long, people who take one, especially if you're a company which is selling on an installment basis, and you're collecting over 3 years or 4 years, then those receivables are not really liquid, right? Your bank balance is really ready, right? You can withdraw at will, right? So cash and bank balance, usually in India, we put it together. Yeah, so yeah. The one is the green stuff that we'll all love, that's in our pockets or in the cash register. The other is for what is in the bank. Some of you will see also those two should be combined, right? So current assets is broad. We'll start with cash, the bank balance, then financial investments, short-term financial investments. Then you have inventories, receivables, then you have these deposits, prepaid expenses, etc., etc. A lot of them are. Right. For a quick ratio, yeah. We'll have cash, short-term investments, receivables, and some other things which are really not liquid. That's what I'm trying to say. No, I'm saying in the book, I'm just trying to be consistent with the book so that there's no confusion in the class. This is the formula used in this textbook. Other textbooks use the formula cash plus short-term investments plus receivables, right? So that's a variation, but for the project, I'm saying use this formula. This is not the best formula. Yeah, yeah. Right, right. Oh, I've given a different formula, is it? Okay, okay. So I'll fix that after class. Sorry, there's some inconsistency. Yeah, I use another book in the other class, so that is a spillover from there. Okay, I'll fix that and send an email because I've already sent you too many emails. So I'll send an email saying correct this in your section. Okay, so the point is there's an error in the formula in the Dr. Reddy spreadsheet in your spreadsheet, which I'll fix after class. Okay, so moving on. Okay, so the next set of ratios are called turnover ratios. Sometimes they are discussed not in this segment on liquidity, they are discussed in the segment called turnover or efficiency. They are called efficiency. So they tell you about how efficiently you're utilizing the assets. I prefer to think of them as an indicator of liquidity. Okay, so and we'll see why in a few minutes. Right? So there are different types of turnover ratios, and all of them have the following form. They have a measure of sales or a measure related to sales in the numerator, and the denominator is some average investment in some kind of a current asset or current liability. Right? So one way to think about it is, it's saying I'm investing a certain amount of receivables in receivables. Let's look at the first one, receivables turnover. You have a certain amount in receivables, and how much sales are you generating on that investment? That's one way to think about it. Right? So the other way to think about it is a measure of liquidity. So to see that, so if you look at the formula, you have credit sales in the numerator divided by average accounts receivable. Sorry? Yeah, go ahead. Just an echo, okay. My voice, I was saying sorry. Okay, fine. Right? So the first formula is not so intuitive. So I've still asked you to calculate it. So generally your sales will be much larger than receivables. So you would have gotten, if you've done the calculation, sales, let's say is 1 crore, receivables is like 10 lakhs. So you'll get a receivable turnover ratio of 10:1, right? It's not a percentage, right? So when you write the numbers, you write it as 10 or 12 or 5 or 6, right? So that's one number, but that's not intuitive. The second number is when you take 365 and divide it by the receivable turnover ratio, what you get is something called days receivable. Okay, so that I'll give you the overview and then try to give the intuition. So that is telling you how long it is taking you to collect money from the customer intuitively. Okay, so if you get days, so 365, you calculate the receivable turnover as sales divided by average receivables, and then you get a number like, let's say 12. Okay, that's your receivable turnover ratio. 360 divided by 12 will give you 30 days. So the interpretation of days receivable is, it's taking 30 days for you to collect money from your customer. I like to frame it like this, it's taking 30 days for your customer to become cash. Okay? So every asset is something which is, the firm wants to become cash because cash is useful, right? So you have somebody like a customer, that's an asset, but we want that customer to become cash. We don't have any emotional attachment to the customer. Right? All we want is the customer to become cash. Right? So the days receivable or the average collection period is telling you how many days does it take for your customer to become cash. Okay? So that's what it is. Now to get the intuition for that formula, let me just do some basic ratios and proportions. So just this is going back to your 7th standard mathematics, right? Ratios and proportions. So you have, let's say, sales of, let's say, 10 lakh.
Sorry to interrupt you, sir. We were not able to see your screen.
Oh, I have to share the screen then somehow. What do I do?
Even the video of the class is cool.
Okay, I stop sharing. Oh, you can't see no.
So the screen was visible. Classroom was not visible. Yeah.
This I'll continue to share, that's fine. There was start video, should I? Is unable to detect a camera. Camera has disappeared. Huh?
It's up.
It's back, is it?
Yes. Yeah, it's visible now.
Okay, fine. Sorry. So one thing we should do is fix the lights a little bit here. No, that's not. What? Yeah, okay, I'll just try without the lights, it's fine. Okay, so let's say 10 lakhs are the sales and receivables are 1 lakh. Okay, so I'm going to do some hand waving. Hand waving means I'm not going to give you the correct answer. I'm thinking about this as a research question, and so I don't have a perfect answer for this thing, but I'm going to try and give you an explanation for what this day's receivable is capturing. Right, so you have sales of 10 lakhs and receivables of 1 lakh. So sales are happening throughout the year. 1 lakh is what is uncollected from sales at the end of the year. Now, in terms of the formula, what we are saying is this 10 lakhs relates to 360 days or 365 days. Right? So if 365 corresponds to 10 lakhs, then what is this number? It will be something in days. So that's what the formula is saying. So it's 365 into 1 lakh divided by 10 lakhs, and that will give you a number in days. So that's why you're getting a number like 30 days or 20 days, 40 days, etc. Okay. So one of the things I try to do, as you know, I'm not going to do it in class, is I randomly generated sales for every month. Okay, so imagine you have you can use Excel rand between function, right, and generate 12 months of sales. Then you impose a collection policy. Okay, what is a collection policy? It says something like, how long does it take for your customer to pay? So I said, let me use a hybrid collection policy where 80% of the customers pay within a month and 20% of the customers pay within 2 months. Okay, so that will allow me to generate at times for the 12 months of sales. I can figure out how much will be the receivable balance at the end of each month because I know how much is collected, right? So I can generate it. Okay? Then I go and apply this formula, okay, for days receivable. Given the actual sales data and actual receivables data that I randomly generated, and I get a number, which is this formula. That number is very close. So what is the actual collection period? It's very simple. You don't need to do this random number generator, etc., because you know 80% are paying within 30 days and 20% are paying within 60 days. So you take 80% of 30 plus 20% of 60, take the weighted average, and you'll get a number. That number is very close to this number. It's not exactly the same. So I was trying to prove that this number corresponds to the theoretical number, right? But it's not exactly the same, right? So, but roughly now that's my kind of hand-waving proof of what this number represents. Now, for the purpose of the project and for the class, intuitively, it represents how long it takes for you to collect from your customer or convert your customer to cash. It's not exactly that, but it's pretty close, is what I'm claiming. Alright, so one interpretation, if this number increases, is this good or bad? The days color receivable. It's bad, right? So when you look at trends for your project, you want to look at that. If it's increasing, then this company is having trouble collecting from the customer. Or either the customer's quality is coming down, or the economy is doing badly, and therefore everybody is suffering, and therefore they're not able to pay, etc. Right, and so on. Okay, so that is days receivable. Now moving on to the next one. So let me move this out of the way. second one is inventory, same idea. So here you have a formula of cost of goods. So inventory turnover, you're investing something in inventory and you're generating sales, right? Inventory you invest because you want it to become sales, right? So this one way to interpret this formula is it's a return on your investment in inventory, right? And we use cost of goods sold, not sales, because inventory is always at cost. Right? Inventory is at cost. If you put a lot of websites, actually they calculate this turnover ratio as sales by average inventory, which is wrong because inventory is at cost, whereas sales includes a margin, right? So you want to use cost of goods sold divided by inventory, and that is why we went through this whole hullabaloo about calculating cost of goods sold, because I want you to calculate inventory turnover ratio. It's a very important ratio, right? So that's the main reason we did that cost of goods sold calculation. Some of the groups whom I met, we have gone over that calculation. Others we'll meet the next few days, right? So that is COGS by inventory. So that's again going to be a number like 5 or 6 or 12, etc. And then 360, let's say its inventory turnover is 12, just to keep it simple. And you take 360 divided by 12, you get 30 days. So what is the interpretation? It's saying 30 days. For 30 days, you are not able to find a customer. So inventory is sitting on your shelf and it's unsold. Okay, so that's the interpretation, right? So days inventory is giving you the number of days it takes for you to sell your product or find a customer. Right? So days receivable is how long does it take for your customer to become cash. Days inventory is how long does it take for inventory to become customer. Make sense, everyone? So longer this number, bigger, let's say days inventory for your company, one of your companies, 40 days last year, it has become 45. Is that good or bad? Okay. Why is it bad? It's longer time. So that means you're struggling, your marketing is not doing a great job. That means you're struggling to find customers and struggling to sell the product. But there's one exception. Yeah, go ahead. A TO is turnover. Inventory turnover, I call it a TO. Sorry, that. So you get the inventory turnover. The first formula is cost of goods sold by average inventory. That's your inventory turnover formula. See, inventory turnover equal to, there's a lot, big space, and then equal to COGS by average inventory. Right? So you find your cost of goods sold, find your inventory from the balance sheet, take its average. COGS by average inventory will give you a number. And that number will be 3, 4, 5, 6, 12, 20, etc. Right? So that number, then you take 365 and divide that by inventory turnover, you get your days inventory. Make sense? Right? Okay, so in general, days inventory going up is not a good thing. That means you're having trouble selling the product. Right? So these two numbers are very, and gross margin. These three numbers are one of the best predictors of how well a firm is going to do in the future. That's what studies have shown. Right? Of course, you need to look at ROE, etc. But these are very good signals. If these deteriorate, then this company is generally in trouble. Right? So that's why these are very important to track. Yeah, you can do it quarterly also if you want. Yeah, if you have quarterly, you'll have opening quarterly inventory, ending quarterly inventory. You take the cost of goods sold for the quarter and divide it by it. Right? You want to keep apples to apples, right? Okay. Yeah, I was going to say, yeah. The exception is, generally you say it's going up, but sometimes a lot of businesses, especially if you're in contract manufacturing, there are two models. If you're an FMCG, like some of you have picked Marico, etc., right? If you're an FMCG, how do you do your demand? You say your production, you say I'm going to estimate my demand for the year. I'm saying, okay, I'm going to sell 100,000 units or 10 crores of stuff, and then I plan my production accordingly. Okay? So there what happens generally, when you plan your production, you miss forecast demand and you're stuck with a lot of inventory because you thought it'll be 10 crores, it didn't work out, marketing didn't do a great job, or the customers didn't materialize, and so you're stuck with a lot. You produced a lot and you're stuck with a lot of inventory. So that's the first kind of scenario. There's a second scenario where you don't really forecast demand, you just wait for the customer to come to you, and you say, the customer comes and gives you an order. And the order comes first, you want to make sure you have the order, and then you start building. So then what happens is you've gotten the order, and you start building inventory. So and you have not made, that's still not a sale. So inventory is piling up. You have not sold the product, but it's good because it's going to become a sale in the short run. So there will be many companies where days inventory will increase, and it's increasing because it's contract manufacturing and you're buying because you're anticipating to sell it in the next. You're pretty sure you're going to sell it, right? So in that sense, sometimes days inventory increasing is not really bad news, right? You have to look at the industry. But most of our companies, FMCG or pharma, it's generally, studies have shown days inventory, when it goes up, it predicts declining sales and declining profitability, right? Very empirically, it's been documented. So that's your days inventory. Okay. Last thing is days payable. So now we have how much time it takes for you inventory to become customer to become cash. Now the flip side is the suppliers, right? So what is this last one? Purchases by days payable. So that is your what we call the payable turnover ratio. So again, it's something like sales in the numerator, and the investment by the suppliers is in the denominator, right? So it's again a turnover ratio. Now, if you take 360 and divide by this payable turnover ratio, what do you get? So again, this is why we had to calculate payables, right? Purchases. For that payable turnover, for this ratio, I've asked you to calculate purchases, and that's not given directly, and so you have to calculate it, right? But this ratio is so interesting. That's why I make you work and do the calculations, right? So what is this? If you take 365 and divide it by your purchase turnover ratio or payable turnover ratio, let's say again it's 30 days, so you get a payable turnover ratio of 12, 360 by 12 will give you 30 days. So that is telling you how long does it take for you to pay off your suppliers, right? Very intuitively, right? So if it takes 30 days for you, generally you will have a credit policy, or the supplier will have a credit policy, right? So if their credit policy is 30, roughly it should match with this, and you're paying on time, then this days payable will be about 30 days, all right? So again, if this increases, what is it? Is it good or bad? Some are saying good and some are saying bad. Yeah. Okay. Okay. Yeah, it could be good, yeah. But sometimes if you're not paying, days payable is increasing, actually you're cash constrained, you don't have enough money. Yeah. Is bad. So it's very hard to say is what I'm saying. Generally, another way to think of a finance, I want you to have a finance mindset. The finance mindset, it's kind of related to what you're saying. It's this idea of an opportunity cost, right? So if you normally you pay 30 days, right? So the credit period, the supplier is saying you have to pay within 30 days, and you calculate your days payable and it works out to 30 days. Next year, 1 year, let's say it goes up to 40, right? So in a way, it's good because that 10 days extra that you got, that means you saved cash. What is the opportunity cost argument? You didn't pay for 10 days. To the extent you don't pay your bills, you have 10 days worth of cash with you. And that cash, what can you do? You can put it to work, make it go work for you and invest it in some investment and generate a return. So that 10 days allowed you to generate an extra return, which is good, right? So in that sense, days payable increasing is actually good, right? But so we can't really say, but most of the time we say when it's increasing, it means you're in trouble. You look at the other things, days receivable is also increasing, days pay, so you're not collecting, so you put it all together and then make a conclusion, right? You have to really interview the executives and talk to the suppliers to really find out what's going on, right, with days payable, right? But that's the idea. Okay, so we have days receivable, days inventory, days payable. Now we put it all together into a very nice number called the cash conversion period. Right? Again, very intuitive. So you have days receivable, how long it takes to collect from your customer. Days inventory, how long it takes to sell your product. So let's come up with some numbers. Let's say 40 days is your days receivable. 30 days it takes for you to sell your product. So 70 days is the sum of those two. What does that mean? It means that for 70 days you're out of cash. Right? This whole thing with working capital. What is this working capital? When you have some cash. Let's say you don't have any suppliers. Everything is paid. You pay your suppliers right the moment you purchase, right? And so then you have some cash, right? So what do? You pay off your suppliers. So you have invested, right? And then you're waiting for this investment in inventory to become cash, right? So to that extent, the sum of these two, the 70 days, you're waiting for the inventory to become a customer and the customer to become cash. So that's like your waiting period. Right? Now, in this example, 70 days, so 70 days you're waiting, that's the longer that number, is that good or bad? If that the sum of days receivable in day inventory, it's bad. Longer it becomes, longer you're out of cash. Now the good news is suppliers are not so bad. They will give you some time. So what is happening is, if your 70 days is a sum of days receivable and days inventory, to the extent suppliers give you credit for 30 days, say they say, you can pay after 30 days, you can breathe a little bit. So effectively, you're out of cash only for 40 days. Right? So the cash conversion period is telling you, for on a net basis, how long are you out of cash? And that tells you, what does that tell you? Tells you what is the length for which you should borrow, the period for which you should engage in a short-term borrowing, right? So if you have, let's say you have 70 or 30 plus 40, 70, and you get days payable of 30, you have cash conversion period of 40 days, that means you need a 40-day loan. Why do you need a 40-day loan? Because you can't get, the customers are still not become cash. Inventory has not become customer, right? So, but you have bills to pay. You have to pay your employees, you have to pay interest on your loan, etc., etc. So you need the cash, right? So that's how you borrow money. So you may have a short-term borrowing to make sure that we are able to meet our bills. The other bills are being paid on time. So if this cash conversion period increases, generally it means you have to borrow more. You have to borrow more, and for longer you're going to pay more interest. So it's not a good, right? So longer the cash conversion period, that means this firm is having liquidity problems. Okay, so that's the sum and substance of this segment. So let me just pause and see if people got the idea. The nitty-gritty of calculating this we'll do in our private discussions or emails, etc. But I just want to get the intuition out there. Okay? So we have a few more ratios. I'll just go over them, but let's see if there are questions. I'll stop here. Yeah. Exactly. Yeah. That's a totally different thing. That's your working capital budget, right? So that's what we call cash budgeting. So what you have to forecast your sales, and you have to forecast your expenses, and then you incorporate all of this collection, like this random number thing I was telling you. You have to do something like that to figure out what is your credit policy, what is your supplier policy, what is your days inventory, and then figure out how much cash, amount of cash. Okay? So that's a different. They're all related, but that's a cash budgeting exercise here. Okay, so these are short-term liquidity ratios. So we have current ratio, quick ratio, these three turnover ratios, and their associated days, and the cash conversion period. Now, okay. Sorry. Okay, so the last thing we will do is solvency ratios. So these are very quickly. So generally solvency ratios are, from the book, they are liabilities to equity, long-term liabilities to equity, etc. So the idea here is bigger these ratio. What I mentioned before is, if you borrow a lot, it's very risky because you'll have to pay back the debt and you may not have enough money. So your long-term solvency is somewhat under doubt. So if you find a company long-term, these ratios are increasing, that means they are borrowing more, they are exposed to this risk of bankruptcy. Right? So it's possible suddenly something will happen, the economy will go down, and you'll be left with a lot of debt and you'll have to pay them off. So you have a solvency problem. Right? So the first set of ratios are about, in the short term, can I make my payments to suppliers, etc. These are about, in the long term, can I pay off my lenders and other liabilities. Right? So these are very simple. Higher these ratios, more is your solvency risk. It's not in general, it's not a good. Okay, so remember always a trade-off. When you borrow more, your ROE is going up. So in that way, it's good. On the other hand, if you borrow too much, you have this risk of going insolvent or back. So there's like, how do you decide what is the optimal? That's something you'll study in module 3 under corporate finance, right? What's the optimal capital structure? Okay. The last thing is what we call interest coverage or interest covered. Here I use the word times interest earned. In the textbook, it's called interest coverage. So it's essentially saying how much profit is there to cover your interest. So denominator is interest, numerator numerator is profit before interest. So you're taking your profit, adding back the interest expense and getting a certain amount. So it's like your flow, how much profit you have to pay the interest. So generally larger this amount. If this number is 12 or 15 or 20, that means you have a lot of cushion, you have a lot of profit, enough in profit to pay off the interest. So it's higher this ratio, it's better. So that's the overall. Yeah. Okay, so EI and DO, so that relates to the project really. So there let me just, I come back to this, exceptional items and discontinued operations. Give me 1 second. Yeah, so in terms, let me just summarize now, we are coming towards the end of the schedule time. So only the diehards will remain. So before so the others will have other things to do. So the only other topic I have not covered is PE ratios. But PE ratios, you can look at my slides, there's some fancy equation in there. But I want to give you a very, very intuitive discussion of PE ratios for, especially because it's related to investing, right? And wrap up the class. And then the project, the questions like this EINDO, whoever wants to remain, we'll solve that question. So I would prefer to take that question and you reach out to me by email or after class if you have time we can discuss. Okay, so last thing, so we have covered all of this. For your project, what I've asked, when you form your conclusion, you're going to look at all of these ratios in the spreadsheet, you're going to calculate trends in them, and then draw a conclusion. Is this company doing well in terms of profitability? Are the shareholders doing better than operations? How is their liquidity doing in terms of the various ratios? How is the solvency doing? Now, in addition to that, remember when you did your first milestone, you had the summary table, where I asked you to calculate or report the PE ratio, right? So when you do your conclusion, this is something I try to tell people, generally sometimes it works. I want you to become logical in your conclusion. So what does logic mean? It means whatever you did in milestone 1, whatever you did in your spreadsheet and the answers to the questions related to the spreadsheet, put them together and say, based on these facts, I'm recommending that we should buy the stock or sell the stock, right? So you don't want to put some new material in your conclusions, right? So this is kind of a discipline, academic kind of discipline. So when we write research papers, that's what we try to do. We don't put some new thing, hey, I saw this in the news about this company, and you add that to the conclusion, right? So everything should be a package, right? So the PE ratio, how do you take that summary statistics and feed that into the conclusion? That's why I'm going through this discussion. So we'll talk about PE ratios. Now, PE ratios are on a price per share divided by earnings per share. What does a PE ratio measure? Right, so that's where my slides, which I won't cover in the interest of time. Generally, the bottom line is PE ratios are indicators of two things. One is your expected growth in profits, and the second is the negative effect is the riskiness of the firm, right? Formally, if I show you that equation, it may be a little scary. All of this. So that's the equation, which is for a PE ratio, and it will take a while for me to unpack it, right? But basically, if you look at this ratio, don't worry about all the characters. If you focus on the change in RI is like profit. Think of it as some kind of profit. So it's a growth in profit. Okay. Now, an RE is your cost of equity or a measure indicator of risk. Higher the RE is, higher is the riskiness of the firm. Think of it like that. Okay. Now let's do a simple math. Suppose I set change in RI to 0. Okay, what will happen? That entire thing in the bracket will become 0. All of it will go. It will become 1. Sorry, 1 plus 0. Okay? And then you'll be left with D by E. Now this D by E, PE ratio, tell me what are the numbers usually like? You'll remember your submission? 20, 30, 40, 50, 60, 80, something like that. D by E is dividends per share divided by earnings per share. That will be some number which is in the decimals, 0.2 or 0.1. So you can ignore it, okay, for all intents and purposes. So what this is saying is, if there is no growth in earnings, if a firm is unlikely to grow in earnings, that whole thing collapses into a small number, 1 plus RE divided by RE. Okay. Now RE, it turns out, is like a return on, it's like a return, expected return, right? So in finance we have this theory which says that, and you all know this, higher the risk, higher is the return I need. If I'm going to invest in make an investment, and it's very, very risky, I'll want some compensation for the risk, right? So higher the risk, higher is the yield. That's the expression, right? So RE is a measure of risk, right? So if your expected return is about, let's say, is 10%, right? And there is no growth, there is zero growth in earnings, this whole formula boils down to 1 plus RE by RE, right? So what is that? So it will be 1 plus 0.1, 10% is the expected return, divided by 0.1, which will work out to 11, right? So a P ratio formally should be equal to about 11 if you are expecting a return of 10% on your investment. That's what the formula says. This is a theory. Practice things don't work like this because the markets are crazy, right? So what you will see, so back to the formula, what this formula is saying is the P ratio depends on two things. How fast you're going to grow in terms of profitability, that's the change in RI. And second is how risky you are. The riskier you are, lower will be the P ratio. The more you're expected to grow, the higher will be the P ratio, right? So now you have a benchmark. If it's above 10, either this firm, the investors are thinking this firm is not at all risky, or it's going to grow in a phenomenal fashion. So if you see a P ratio of 40, 50, right, and many of you have that, that means the market is thinking, P is price. So this price is an indicator of what the market is expecting. And so the market is expecting this firm is going to grow in a phenomenal way. Okay? So that's the bottom line. So P ratio is an indicator positively related to expected growth and negatively related to risk. So you look at your numbers, and if you think P ratio is relevant, then when you're forming your conclusion, for example, your company's PE is greater than that of the competitor, the peer. That means the market is thinking your company is going to grow much more. And so that should help you in your recommendation. 50%. Okay. 3, it will be 3. 1.5 divided by 0.5. Yeah, that'll be very. Yeah, that is risk cost. Okay, very good point. What 50%, if you're expecting 50%, that means you think this company is going to be. Why are you demanding 50%? Because you want to be compensated. This company is very, very, very risky. So you're saying, I'm going to take the risk. I'm willing to take the risk, but you have to give me 50%. So therefore the PE will be low. As the risk goes up, PE will fall. Higher the risk, higher will be the expected return, lower will be the PE. It all works out. So PE is high, it means one of two things. Like I said, one is, it means the growth is going to be phenomenal. So you see a PE ratio of 70. I'll give you the rational explanation. PE is very high, it means you're going to grow at a, sorry? Yours had 96, is it? Short the stock. That means the market is super optimistic about it. India, we find this all the time, and I can't believe it. Right? US, the average PE ratio is 15. Right? In the internet boom, things went to 100, then you know something's wrong. Right? Because the PE, back to our discussion, mean reverting. PE ratios, when they're very, very high, they will drop. Because P and E move together. So when you see a high PE, back to the interpretation, there are two things you can say. One is, market is crazy. So if you belong to the inefficient market camp, in your conclusion you can say the PE is too high, not a good stock, I'm going to sell the stock or short. That's one way. But you should have a kind of a behavioral story to support it. Right? Because you look at the fundamentals and say these fundamentals are really, really weak. The company is not doing well, but the PE is so high, price is so high, so I think I should short the stock or sell the stock. If the other reason PE can be high is the two rational reasons. One is the market is actually right? And they think earnings are going to become very, very, very high. And therefore they're giving them a high price because the price is related to expected earnings. Or the second rational reason is they think the stock is not at all risky. It's like a treasury bill or a government security. It's a very, very safe stock, and so the expected return should be very, very low, and so let's say your expected return is only 1%, 0.01. So you'll get 1.01 divided by 0.01, so you'll get a very high P. Right? Okay, so I'll end with one thing. This is the way to think about it. Same thing I'm going to say in pictures, if I can find the pen. This is the last thought I want to leave you with. And this goes back to a paper by a professor called John Campbell, who was at Princeton when he wrote this paper in 1987. But the idea is knowing what a PE ratio is very important, because when you watch CNBC, this is what they'll talk about. They'll talk about the stock is very cheap or the stock is very expensive. What do they mean? They're talking about PE ratios. When a PE ratio is very, very low, that means the stock has been battered, it's down to the bottom, and therefore it's very, very cheap buy now. That's the message. When the PE is very, very high, they're saying it's too expensive. The price is too high, that's why the price is way higher than what the earnings are. And therefore, don't buy the stocks, dump it. That's the idea. Right? But in terms of how do PE ratios behave, if you do a timeline, what will happen is the PE ratio tends to go up and down like this. You plot it over time. Right? So suppose you have, I don't know if the guys on the other side are able to see this. Not sure.
Yeah, it's very good.
Yes.
Okay. So this is your PE ratio timeline. So imagine your PE ratio is somewhere here. This is your PE ratio. It's very, very high. So the mean is about 25. Your current PE ratio is 80. So what are the two things that can happen? Very simple math, P by E. And we know PE is mean reverting. Mean reverting means when it's high, it can't remain high, it can't go off the charts. It has to come down, right? That's why the nature of a mean reverting process is it will go up and come back to the mean. The mean in this case is 25. Historically, if you take the average PE over the last 20 years, it will be about 25. So now it's at 80. So what can you do? You can be sure it's going to drop. The PE ratio will drop. How will it drop? There are two ways it can drop. One is price can fall or earnings can fall. So if you're belonging to the rational markets camp, you will say PE ratio is very high, no problem. Price is right. It's just that the earnings are going to go up. When the earnings go up in the future, the growth is going to happen, it will get realized, PE will drop, and that's fine, no problem. I will invest in the stock. Right? The other is the irrational or the behavioral camp. It says that PE is high because price is too high, earnings are not great, and so people are optimistic, overly optimistic, and so I think after some time the price will drop and it will hit the mean, and before anybody finds out, let me short the stock, sell the stock, and then I'll make some money. Right? Or at least avoid my portfolio tanking. Right, yeah, the closing price per share, yeah. Earnings per share. Remember that EPS? No, there's no dividend. So the PE ratio, remember that formula I showed you? This formula is theoretically valid. I can't prove it to you. So there is some dividend element in there, right? Right. So you might be coming from this thing that price should relate to dividends, etc. That's a different model, dividend discount model. In this model, we are using earnings to value the stock, right? Turns out that Jim Olsen, who's a professor at Columbia, he's the guy who resurrected earnings. So in the 70s, 80s, everybody swore by dividends and cash flows. So to value a firm like in Goldman Sachs or anything, they would use dividend discount model or the cash flow valuation model. Till 98, so all of us, I'm an accountant and an earnings person, and I'm like, and earnings has no role to play in valuation. So everybody, we were all like and this guy wrote a paper, this person wrote a paper saying that you can use earnings to value the firm. So that's where this is coming from. This formula is coming from. Right? No, you can calculate it, yeah, quarterly or annually. Yeah. Yeah. Price will be, price is fluctuating every day. EPS is very infrequent. Once a quarter you'll have so that's why you have trailing 4 quarters. Yeah. Today, so you take P today and you take the last 4 quarters. The way people do it on the street is you take the last 4 quarters of EPS. You can find that on Money Control. You go to the quarterly tab and it'll give you a time series of EPS. So you add those 4 quarters and that will become your denominator. That is the historical P. Okay, so price today, any price, you pick any price today or tomorrow, You can calculate P ratio is fluctuating every minute because price is fluctuating every minute. That EPS denominator is stable. It is very slow moving. Every quarter it will change. Right? It's a annual number. Annual EPS should be in the denominator. Or if you don't want to use quarterly, you will use the most recent annual earnings per share. Now, where do you find it? You can find it on a money control website, or this EPS you can find in your annual report. You have to search for it. Search for earnings per share and you'll find it. It takes a little bit. Sometimes they put it in some table, schedule or footnote. Okay, makes sense, everyone? Right. So that's all I wanted to say on the subject. So the class ends now. And sorry we went over, but I hope it was useful and instructive. Okay, so the rest of the discussion, and so in terms of the project, now we are done, officially we are done. So people who want to sign off, that's okay, but some groups have already met me for the project submission. So remember the due date is 28th, right? Tuesday. So that time is, we are running out of time in a way, right? Sorry? Only the ratio sheet has to be submitted. So after some days after that, you will have to submit the project. So the extra, after you submit the spreadsheet, then I have given you a document which has some 12 questions. And each of those questions requires you to populate a table, which you already have done, and add about, I will say, 5 or 6 sentences of text to each of those 12 questions. Okay, so that's the ask in terms of the final submission. Right, so answer the 12 questions and put a conclusion about whether you will buy the stock based on some logic. So, I think Soumya sent me at December sometime. So you guys apparently voted for an early submission before the final exam. So that way after the final you're done. You're free of this scourge. Sorry? So milestone 1, let's clarify the language. Milestone 1 is done, dusted. I've given you feedback. Everyone has gotten 15 groups. I gave you all individual feedback. Milestone, what I call milestone 2 is that ratio analysis spreadsheet. Just an Excel file has to be sent email to me by that 28th. That's the date you guys have agreed. That's milestone 2. Then the third element of the project, we won't call it milestone 3. We will call it final submission. Will include milestone 1, the ratio spreadsheet, answers to 12 questions, and a conclusion. Okay? Put them all together and send it to me as an email. No modal, etc. Just email me one submission per group. Okay? So on that final submission, I will send you separate emails to, I've already given you everything, but I'll send you a separate email again so that, you're all busy and multiple things going on. So to make it clear. Okay, so that's, I don't know what, let me talk to Soumya and Suresh here and ask them what. I got the impression that this ratio, my preference, I'll tell you my preference, was you finish the ratio spreadsheet, then you start, okay, I want to clarify, I'm not the center of the universe, and my course is not the center of the universe. I know you have thousands of things going on in your lives, but in one of those things, you have to prepare for the final exam, right? So that's one of the things that you have to do. So that you do after you submit your milestone, the ratio analysis spreadsheet, milestone 2. So that you will have about 2 weeks. And you have your exam on 16th, and then you submit, you take some time, and submit it on December 25th or something. That's what we agreed. So maybe I confused you guys about it. Yeah, so that's the timeline. First finish the ratio sheet, then take the exam, and then the final submission. Those are the 3 deliverables from your side. Okay? Make sense? All right. Okay. So any other questions from the class? Any? Yeah, like I promised, I'll send you a sample quiz and also one more problem set. But let's get over this deadline, right? Unless you're super enthusiastic about it, Okay, but give me, Tuesday is due, right? By Wednesday or Thursday I'll send it to you. Give me a few days. I've not worked on it yet, right? So next few